You bought a stock at $100 a share. Today, it's worth $60. You haven't sold it, but you also haven't bought more of it either. Here's the question that exposes what's really going on. If the price is $60 right now and you wouldn't buy this stock today at $60, why are you still holding it? That's not a trick question. It's the exact moment where most investors quietly make one of the most expensive mistakes in finance. It's called loss aversion. And by the end of this video, you'll see exactly how it cost investors fortunes in two of the biggest crashes in modern history, and how to finally break the pattern. In the late 1970s, two psychologists, Daniel Kahneman and Amos Tversky, ran an experiment that changed economics forever. They found that losing $100 feels roughly twice as painful as gaining $100 feels good. Same amount of money, completely different emotional weight. They called this loss aversion, and it's hardwired into how your brain processes risk. Now apply that to investing. The moment you buy a stock, your brain quietly draws a line in the sand, your purchase price. Above that line, a gain, something to feel good about. Below that line, a loss, something to avoid feeling. The problem is the stock market has never seen that line. It doesn't know your purchase price, and it never will. But your brain treats it as the most important number in the world. So instead of asking the only question that actually matters, is this still a good investment at today's price? You start asking a completely different question. How do I get back to even? And that single shift in the question you're asking is where most bad decisions begin. Let's see this play out in real numbers. From its peak in October 2007 to its bottom in March 2009, the S&P 500 fell 57%. Not a typo, 57%. Imagine watching your retirement account cut more than in half over 17 months. For a lot of investors, loss aversion kicked in early. As the market dropped 10, 20, 30%, the thought was the same. I can't sell now, I'd be locking in the loss. So they held, and held. And then, in early 2009, when the news was at its worst, and the losses were at their largest, that's when many investors finally sold, right near the bottom. Here's what happened next. By 2013, the S&P 500 had climbed back to a new all-time high. By 2019, it had nearly tripled from that March 2009 low. The investors who sold near the bottom didn't just take the loss, they paid for it twice. Once on the way down, and again by missing the entire recovery on the way back up. Now fast forward to 2020, and this time, everything happened much faster. Between February 19th and March 23rd, 2020, the S&P 500 dropped 34%. In about a month. The COVID crash was one of the fastest, sharpest declines in market history. And headlines were calling it the start of a new Great Depression. March 23, 2020 turned out to be the bottom, and from there the market staged one of the fastest recoveries ever recorded, back to new all-time highs by August, just 5 months later. Here's the part that matters most. The recovery started while the news was still terrifying. Case counts were still rising. Lockdowns were still expanding. It did not feel safe to buy in March or April of 2020. It felt safe again around August, by which point the market had already recovered almost everything it lost. This is the pattern. Every single time. The recovery does not wait for sentiment to improve. By the time it feels good to get back in, much of the gain is already gone. So why does this keep happening? It's not just loss aversion on its own. It teams up with two other biases. The first is the sunk cost fallacy, the idea that money you've already lost on paper should influence what you do next, even though that money is gone either way. The second is mental accounting. treating your purchase price as a meaningful boundary, almost like a finish line you have to cross again before you're allowed to move on. Put them together, and you get the most common sentence in investing. I'll sell when it gets back to what I paid. That sentence feels reasonable, but the market has no idea what you paid. Your cost basis isn't a line on a chart anyone else can see. It's not a level of support or resistance. It's not information. It's a number that exists only in your head and on your brokerage statement. And it has zero bearing on what that business is worth tomorrow. Benjamin Graham, the father of value investing and Warren Buffett's mentor, described this perfectly with a thought experiment in his book, The Intelligent Investor. Imagine you own a small business with a partner named Mr. Market. Every single day, without fail, Mr. Market shows up at your door. Some days he's euphoric, and he offers to buy your share of the business for far more than it's worth. Other days he's deeply pessimistic, and he offers to sell you his share for far less than it's worth. Here's the key. You're never obligated to act on his quote. You can ignore him completely, and the business keeps running exactly the same either way. Graham's point was simple. Mr. Market's price on any given day is driven by emotion, not by the value of the underlying business. And critically, Mr. Market has absolutely no idea what you paid for your shares. Neither does the business. The only thing that should change your mind is new information about the business itself, not where the price has been. This isn't just theory. It shows up in real trading data. In 1998, economist Terence Odean analyzed over 10,000 brokerage accounts and found something striking. Investors were about 50% more likely to sell a winning stock than a losing one. He called this the disposition effect, our tendency to lock in gains quickly while holding on to losers, hoping they'll come back. And it's almost exactly backwards from what tends to work. Letting strong positions continue to run while being willing to exit weak ones is a core principle behind trend following and momentum-based strategies. And a large body of research since Odean's study has found that investors who sell winners and hold losers tend to underperform the market by a meaningful margin over time. This isn't a flaw in a few unlucky investors. Odean's study, and the dozens that followed it, found this pattern across the vast majority of accounts, across different markets, and across multiple decades. It's not an exception. For most people, it's the default. So how do you know if loss aversion is quietly running your portfolio? Ask yourself a few questions. Are you holding a stock mainly because selling would lock in a loss, not because you still believe in it? Have you stopped researching a position since it turned red? Almost like you don't want to find more bad news. Do you check your losing positions less often than your winning ones? And have you ever caught yourself saying, I'll sell it when it gets back to what I paid? If you said yes to even one of these, that's not analysis talking. That's loss aversion. And it's worth noticing because noticing it is the first step to making decisions based on the business, not the bruise. Here's the test that breaks the spell. Imagine you woke up tomorrow, and instead of holding this stock, you held the equivalent amount in cash. At today's price, would you use that cash to buy this stock right now at its current price? If your answer is yes, then your purchase price is irrelevant. Hold it. Maybe even add to it. If your answer is no, your purchase price is still irrelevant. The only question is whether today's price makes sense for today's business, going forward. Either way, the number you originally paid doesn't appear anywhere in the answer. This is sometimes called zero-based thinking, and it's one of the simplest mental shifts you can make. It removes the emotional anchor completely and lets you evaluate every position the same way, based on where it is now, not where it's been. Let's bring it all together. Loss aversion makes a loss feel about twice as painful as an equivalent gain, so your brain anchors hard to your purchase price, even though the market has never heard of it. In 2008 and again in 2020, that anchor caused investors to hold through the entire decline and then sell right before the recovery, missing it completely. The fix isn't complicated, but it does take practice. Stop asking, how do I get back to even, and start asking, would I buy this today at this price? Your cost basis is history. Your decision is about right now. That single shift, from your purchase price to the present price, is one of the most valuable mental upgrades any investor can make. This video is for educational purposes only, not financial advice. If this helped you rethink your portfolio, subscribe for new behavioral finance breakdowns every week.